This is the Insight is Capital podcast. I'm Pierre Daly, managing editor at advisoranalyst.com. 2022 has been a challenging year so far for most investors. Falling stock and bond prices are taking a toll on investors, making it perhaps the abrupt end to a 40-year period of gains in the bond market like no other, and rates of inflation and inflation growth not seen since 1983. With correlations in stocks and bonds climbing to 100% this year or near 100% this year, it's been challenging at the very least to find much of a diversification punch among those traditional assets. Joining us to talk about how liquid alternatives are integral to diversifying portfolios against today's inflation and rising rates are Jeff Evans and Travis Wetsch from TD Asset Management. Jeff is Vice President and Director of Quantitative Research and Risk Management. He focuses on factor analysis and quantitative risk assessment for the TD Active Global Infrastructure Equity ETF, TD Active Global Real Estate Equity ETF, and Greystone Funds. Travis is lead portfolio manager for the TD Active Global Real Estate Equity ETF, and he is the global real estate sector analyst responsible for the U.S. and international equity strategies.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Jeff, Travis, welcome to the show. It's an honor and a privilege to have you.
Thank you.
Yeah, thank you. Great to be here.
Let's jump in. What are you seeing in the markets today, and how have things evolved over the course of 2022?
So I guess I could probably jump in and start there. A lot of what we're seeing in 2022, I think you could argue, is really just a reversal, or investors questioning some of the trends that had emerged from the financial crisis up until just before COVID hit. A lot of those themes would have been inflation running well below central bank targets, and then of course slowing growth in the global economy. Questioning just the structural growth rates in general. And what that ultimately led to is a lower interest rate environment, and arguably a repricing of assets to reflect that lower interest rates. People leaning into longer duration assets, taking more speculative risk in order to reach for yield and so forth. And all of a sudden in 2022, we're seeing a very significant reversal of that, and investors challenging a lot of those views. Inflation has turned out to be much stickier than the Fed expected. And even now, when the Fed had sort of assumed things would start to calm down, we're just not seeing the drop in inflation that they've been wanting to see. And it really is starting to challenge some of those built-in assumptions over the past decade of how much should we be paying for these longer duration equities, and are we maybe shifting into a new economic environment where inflation interest rates are structurally higher than what we saw. And so that's a lot of what you've been seeing in the equity markets this year is those speculative high multiple segments of the market coming under pressure. The other thing that we're starting to see more recently here is the impact of all of these historically dramatic and very quick interest rate increases hasn't really impacted corporate earnings yet in the United States. And yet everybody kind of assumes that it's going to at some point in time. And just given the magnitude and speed of those hikes, I think the question is, are earnings expectations properly calibrated going forward? We're still expecting 7 to 8% annualized growth over the next 2 years based on consensus. And I think the suspicion is, as we move into this earnings season coming up, you're going to see more pressure and more questions on the earnings outlook. And if that's the case, what we've seen so far is really just a multiple compression driven largely by the move in interest rates and real rates. And there could be the next move down as earnings readjust and expectations sort of start to reflect margin pressure and the increased risk of a recession into next year.
Wow, that's a mouthful. But
no shortage of things going on this year.
Absolutely. I mean, those high beta names certainly have taken a beating. Travis, did you have any additional thoughts on what we're seeing and what's happening in markets?
Maybe as it relates more specifically to real estate, it's been caught up in the market sell-off, as publicly listed real estate securities generally tend to do during periods of market stress. Correlations go out the window, and things tend to be much more highly correlated than suggested by their medium and long-term averages. But I would say that as we look forward and continue to look through the next couple of years and where things might improve, real estate does look quite attractive. The valuations that we're seeing currently in the real estate market suggest that it's trading significantly below its longer term NAV. at roughly 0.85 versus its historical trending range of closer to 1. So we think there's a tremendous opportunity within the real estate space itself.
And many of those being some of the high valuation names, high duration names that investors made popular right up to the end of 21. Given that we're here to talk about liquid alternatives in general, and then specifically about real estate and infrastructure, I think it would be helpful if you could describe, first of all, the depth and breadth of TD Asset Management's experience with alts and real assets through many market cycles that we've seen in recent history.
Real assets have really been part of our legacy, where we've been investing in physical ownership of real estate as well as infrastructure for multiple decades. As you noted, I've been covering the real estate sector globally since 2008 is when that really began. And the sector has really evolved significantly since then, not only with cleaner balance sheets and through lower leverage, but also through the pure number of global opportunities to invest in. Historically, people really refer to real estate as only being office, industrial, retail, and multi-res. But today, there's significantly more types of companies and regions to invest in. Those that are focused in on storage, lab office, towers, data centers, daycares. A significant host of new opportunities to help diversify portfolios. But if we were looking back at the U.S. market and over the last 20 years, real estate assets that are publicly listed or REITs, as they like to be called, tend to outperform in high inflationary periods. Strong income returns offsetting any potential falling REIT prices have generally been what we've seen. And in fact, through those periods, on average, REITs have outperformed the S&P 500 by about 5.5%. In periods of moderate inflation that are sort of listed between 2.5% and 7%, outperformance has been greater than 3%. Periods of low inflation is really where, I guess, REIT returns have struggled, and that's really driven by the strength in the S&P 500 relative to real estate, where the income portion doesn't make up for the superior price returns. So, when we're looking back at history and we're looking forward to what kind of new market opportunities we're faced with, we do see general strength in allocating portfolios towards real estate.
In real estate, in markets today, there's also been a fairly significant divergence between the valuations of public and private asset classes, which makes the public ETF quite attractive today, right? I mean, very high asset quality real estate is on sale right now.
Absolutely. On just the industrial industry itself, looking at where the implied cap rate of the stocks within that grouping, going from 3% to close to 5% implied cap rates, that implies significant devaluation of property values, where, from our physical ownership of assets, we're seeing much less increase in property values. As I mentioned, one particular stock isn't seeing any decline in asset value as of yet. Looking at the Cushman Wakefield's analysis of different industries, they're projecting that by the year end of 2023, you're going to basically see implied cap rates of high fours. So the public equity market is currently discounting implied cap rates that aren't seen in the physical asset market until the end of next year. And that's up for debate whether we actually trend in that direction. There's a significant amount of capital that continues to be placed into the ownership of physical assets. So there has been definitely some softening, but everything from our on the ground research suggests that it's more like 25 to 50 basis points of cap rate expansion. So it's basically put a lot of these publicly traded real estate assets in a significant discount position relative to their physical counterparts.
Yeah, very interesting. I think private equity doesn't have the line item risk that publicly traded markets do, because the valuations aren't marked to market on the private equity assets the way they are on public markets. And so that makes for a really interesting opportunity, and definitely a chance to get into the sector at a nice discount versus what's going on privately.
That's right. Yeah. And we'd seen that through during the periods of the depths of the COVID crisis too, right? Where, initially you did see public real estate, markets sell off dramatically, significantly recover by the end of the year. But, the actual asset values of the private market never changed.
Right. So while the private equity holders were sleeping really well at night, thinking that everything was going swimmingly, you guys were out there snapping up the bargains.
That's right. Yeah,
Yeah.
you do see the potential for taking advantage of that opportunity.
Just add in on the infrastructure side, one of the, I think, interesting attributes of infrastructure, it ties into a lot of the themes that we're seeing right now of inflation in the market. Big concern for investors as to how that impacts portfolios and returns. And what's sort of unique about a lot of the infrastructure assets is the regulatory environment that they operate in, where there's actually an inbuilt mechanism for these companies to recover inflation, not necessarily in the year that inflation's happening, but 2-3 years over time. You tend to see that being captured over the longer term. And very different from most of the other companies in the market that have to try to push prices through. It's a competitive marketplace. You may or may not fully recover inflation in the near term. With the utilities, it's almost automatic. So it's a nice feature of the infrastructure companies in this environment that you really don't have to worry about it too much. It's built into the business model, and I think provides a nice contrast to real estate. You've got a very safe government-driven mechanism. In infrastructure, real estate, you do have a little bit of the competitive dynamics where you can capture what's happening in the cycle over time. But you put both of those together, and they'll capture inflation in slightly different ways at slightly different times. But the net impact is to give you that inflation protection relative to what you see in the rest of the market.
Correct me if I'm wrong, but I like to think of real estate and infrastructure as some of the more plain vanilla liquid alts. They're a lot easier to understand than some of the more complicated or leveraged liquid alts that are out in the marketplace. People can relate to real estate. They can relate to the idea of infrastructure. We all use the 407. How have you seen the liquid alts in particular that you manage, that you look after? How have you seen them perform against what are typically the great weaknesses of today's popular investment portfolios?
Sure. Maybe I can give a first couple of thoughts on just a lot of the standard products that investors have gravitated to in the last couple of years. I think one of the trends is that we've seen a move to certainly more passive products and large market cap based indices. So if you're making an equity allocation, it would be just a broad equity allocation globally and market cap weighted. And one of the there's certainly some merits to that, but the other side of it is, when you hand off that decision making to the market, the characteristics of that portfolio change significantly over time. And what you're investing in, in 2010 can be very different. It's the same product, but the actual exposures within that can change significantly. Just to give you one example of that, 10 years ago, the U.S. was 40% of global equities. Today, it's almost 67%. There's a much bigger exposure to the U.S. dollar, U.S. equities, and the assumption that U.S. companies will continue to push through very high profitability and price performance. And then even within the U.S. side, you've seen large cap tech stocks become incredibly large components of the index with a significant amount of concentration at the top end. So the broad-based equity products that a lot of people have gravitated to and the passive investments, they've shifted over time and have really become much more just a bet on large cap tech dominance. And I think when investors are putting portfolios together, it today is much more critical to actually separate those products out. Don't treat it as a single equity bucket, but actually break the equity market down into the component parts. There's certainly a great case for owning technology companies in some degree, but perhaps not as much as what's implied in the market cap weighted indices. And I think the large institutional pension funds provide a really good example that advisors and retail investors can look at. They got onto this alternatives trend a long time ago, back in the early 2000s. A lot of it was forced on them by changes in pension accounting, where all of a sudden these big unfunded pension liabilities ended up on their balance sheets, and they had to go in and find a way to actually manage that exposure, manage the risk. What everybody did in the dot-com bubble, they dialed up the equity exposure just in advance of that, had some very lofty return expectations on equities. Of course, we know how that turned out. It ended up deflating pretty quickly, and forced everybody to realize equities actually had a lot of risk, and so you had a reversal trying to cut the equity allocation. And the question is, where do you go? Particularly in an environment where bond yields have been coming down. At that point, for 20 years, they've gone down even further, of course. And so it made fixed income very challenging to allocate into. The big concern in the pension funds has also been longevity risk, people living longer. So you need something with an equity component that's going to participate in the economy longer term. And that's where a lot of these alts started to kind of come from, was this need to find a product that has some of those equity attributes. It can participate in the economy and economic growth over the long term, but it still has some of the stability and predictability that fixed income has. And so I think, in terms of, what the large institutions were forced to do is evolve their portfolios to have less equity, less fixed income, and take on more of these alternative products. Of course, they've been much more active in, as you said, the more complex end as well, hedge funds, private equities, managed futures. But what you've seen in the last couple of years is, for the retail investor, some of those products becoming available in ETF form, but it's the real asset products that I think have seen a lot of growth, because it, as you said, is it's an easier product. It's effectively long-only equities. We're taking parts of the equity market and just expanding them and giving them the ability to have a greater share than what they'd have in just a simple market cap weighted index. But what we've seen in a lot of our research is that these are truly distinct assets. Real estate and infrastructure have very different volatility profiles, much lower correlations to traditional equities, and they behave very differently. So when it comes back to structuring a portfolio and trying to optimize it for a particular investor's risk preferences and risk tolerances, you can do a much better job and get a lot closer to the optimal solution by splitting these parts of the equity market out and modeling them separately.
Maybe I'll just add that with our liquid alternative products, we're not using additional leverage. We're not focused in the private equity space, and our focus is really more on those traditional assets themselves, and then on real assets that serve an economy that provides much better inherent stability for the base of our product.
What are the key characteristics of real assets like infrastructure and real estate that behave differently, or make them behave differently from the traditional equities and bonds?
So I think one of the attributes that's very similar between the two is that these are companies with very clear long-term cash flows. Just by nature of the real estate and infrastructure businesses, you get a rent check every month as a landlord, or if people want to continue to receive their electricity or water, you've got to pay the utility bill. So it becomes a very predictable long-term revenue stream, and you can usually model this quite precisely. So that's something that stands out very distinctly from an early stage tech startup where you really don't have that degree of certainty. Right. So I think that's one of the key defining attributes of these companies is the long-term cash flow characteristics, and then of course the fact that they're backed by tangible objects. In terms of how markets have shifted over time, you've seen a lot of the S&P 500 become more intangible. If you just break down balance sheets across the U.S., the last time I checked, it was 25 to 30% of the average company was goodwill or intangible assets. What differentiates these companies is that it's almost exclusively hard assets and something you can touch and see. Much harder to write down the value of that. And the fact that there's replacement value and a physical entity that you can ultimately use to generate and run a business protects a lot of the downside value. So I think that's sort of one of the features that defines both of them. And maybe in terms of sort of the key differences, I think a lot of it comes down to infrastructure relies a little bit more on the regulatory environment for its inflation protection and for the certainty or visibility of the return stream. Real estate would tend to rely much more on leasing and contracts over the long term. So those would be my thoughts. I'm not sure, Travis, if you have other views.
Yeah, maybe just a couple. I'd say, first of all, the cost of construction, generally trends higher over time. That's very supportive for property values over the long term. And REITs themselves, they own those income generating properties, but they also have a number of other levers that they can pull on, tenant upgrades, rent increases, redevelopment of existing properties. They can also do accretive acquisitions, ground up development, JV different products and branch off into new business lines. So there's a number of structural differences there, I think, that provide the benefit.
The key here, I mean, in this market, this world that we're in right now, there's been so much financialization of the market and business. It's nice to come back and remember that what we're actually talking about here are real physical assets. So that's a nice component to add to a portfolio that has largely been, let's say, financialized over the last 20 years, and especially where investors have taken on a larger share of passive type holdings, indexes in their portfolios. It's nice to know when you add assets like real estate and infrastructure to your portfolio that you're actually adding something tangible. In the context of that, how do you best see how investors can integrate real assets in particular into their model portfolios?
Sure. I think maybe the key point is to when you're running models and asset allocation and considering how you structure a portfolio for an investor, taking the whether it's the real estate sector out and treating it as a standalone entity or taking utilities out, it's extremely important, just given the nature of the volatility of each of these segments and the correlation to broader equity markets. What we've tended to see is both of those sectors tend to have lower volatility than broader equities. Part of it is, again, just the defensive nature of these businesses through regulatory constructs or through contracts, and the predictability of the cash flows and reinvesting dividends over time. All that tends to lean itself to being a little bit lower beta and lower volatility over the longer term, which gets missed if you just lump them into a broader equity universe. But also the correlations, and particularly for real estate, has seen much lower correlations to the broader equity market. And generally speaking, you see a risk reduction as well from being invested in the infrastructure space. So I think that's just the key thing. It's not about just modeling equities; it's splitting out the individual pieces,
Right.
And taking it into consideration that way.
And structurally, I'm curious, I get, because we're talking on the subject of correlation, how has the correlation, you mentioned that real assets, real estate, and infrastructure have a structurally lower correlation. How variable is that? Like when we have a market like we've had this year, how has it behaved in the context of this year versus the more normal or the mean?
So over the longer term, or I guess perhaps the last 10 years, just looking at correlations over time, we've generally seen them widen out as a
Right.
generalization, and part of that is just as big technology stocks became a larger and larger part of the indices, and global equities became more growth tilted in nature. These are much more defensive assets, and so that just naturally brought the correlations and widened them out. And then in terms of this year, we've seen a little bit of a difference between real estate and infrastructure. The infrastructure has definitely been the more defensive side, and has held in quite strongly. Real estate's had a little bit more volatility through the year, and maybe hand off to Travis for a few thoughts. But we've seen a little bit of a difference between the two products.
Right.
What's interesting, if you take a 2-year view, it was the reverse last year.
So let's talk about the differences between real estate and infrastructure, because they seem to be very similar. There's obviously some similarities between the two types of assets. So let's focus on what the differences are.
Sure. Maybe just stepping back on a performance basis, through COVID, it's been a challenging market for the last couple of years for sure. But through COVID, the portfolio itself held up extremely well. And in fact, then during the recovery post the vaccine announcement, we actually saw real estate continue to benefit, and up near 30% returns type numbers, keeping pace with broader market activity. It's really this year that we've seen real estate sort of face its challenges and continue to struggle. As Jeff mentioned, infrastructure has been a much more defensive product year to date. So that's sort of interesting to see it. Both the real assets, but behaving much differently within the market. Some of that's related to the valuations and where some of these real estate prices have come from. over the last 3 years, they've benefited greatly from lower interest rates, and that move towards maybe more to defensive tilt. But just for example, if you take a look at where cap rates were at the end of last year, for a name like Prologis, it was trading high twos, low threes. On an implied cap rate basis, and now it's trading closer to 4.5, 5, and so a significant weakness, or higher cap rates, which implies much lower property values. Yet on their Q2 call, Prologis hasn't yet to announce any sort of material negative capital values. In fact, their property values actually increased during the second quarter. So the equity markets, or markets itself are basically anticipating that there'll be a significant weakness, yet we're not seeing it from a fundamental perspective yet.
Very interesting. So, Jeff, what are the differences on the infrastructure side?
So I think one of the things that we've seen, the infrastructure portfolio had some pretty interesting disruptions through COVID, and we were fortunate to launch the fund just after a lot of that started, so we didn't have to deal with the immediate effects. Some of those would be airports, for example, which would be a fairly significant exposure to the fund. Obviously, very materially impacted by COVID with shutdowns. Toll roads as well saw some pretty significant shifts in traffic patterns, and created a number of issues. Structurally being a large part of the infrastructure benchmark, but effectively, uninvestable for a period of time. We took the view that, at some point these would come back. They're fairly resilient long-term assets with strong regulatory environments. Particularly a lot of the Mexican airports, it's odd to see an emerging market economy have a strong regulatory environment, but it's actually one of the best ones globally. And they've seen extremely strong balance sheets. They've been very well managed companies, and also happen to have some of the fastest traffic recovery. So there's been lots of regional splits, where Europe, for example, or Asia has been much slower. So we've seen lots of regional dispersions in terms of how quickly things are coming back. Starting to see dividends in the airport space come back, in toll roads. It's been a bit of a drag in terms of income, whereas other parts of the portfolio, so we've leaned more on the more traditional utilities, for example, and where dividends have been much more consistent through the piece. But even in that space, lots of regional differences brought about this year by what's been happening in Europe. At one point in time, Europe was very aggressively pushing forward on renewables and trying to build out their renewables platform, effectively mandating the elimination of natural gas and coal, and ultimately nuclear power over the next 20 years. That created what people thought was a very visible long-term growth path for the European utilities to decarbonize, build out solar and wind, and generate some pretty significant earnings growth. And what's happened over the course of the years, that has shifted materially.
Yes.
Part of that just being changes in cost of capital. It's become a lot more expensive to finance these wind farms, and I think people don't necessarily realize it, but one of the biggest input costs in a solar or wind farm is actually the financing cost of these over time. So when you have large moves of interest rates, it does change the economics quite a bit. And we've actually had the U.S. become much more focused through the some of the recent government acts that have come out to really incentivize production of solar and renewables. So you've actually had a shift of where the growth is, and seeing a lot of the U.S.-based utilities become much more focused on the renewable side this year. So it's been an interesting portfolio and lots of regional variations, and some of the long-term trends that we thought were in place in Europe really breaking down this year, and shifting into the U.S. So I'd say that's what we've been seeing in the infrastructure portfolio. Just lots of nuance of addressing certain parts that were more affected by COVID, and then lots of variation. Government policy in particular has created challenges on the regulatory side, and just the uncertainty of whether companies can earn a return or invest in renewables in Europe has become a much bigger concern, whereas the U.S. seems to be focused on much more disciplined regulatory environment and incentivizing that investment.
Quite significant differences between the two. Is the bottom line. They're very different. I think we may have just spent so much time the last 20 years focused on stocks and bonds. The breadth of opportunities in both of the spaces that you're managing have quietly expanded and also changed quite rapidly as well. I think one of the most interesting changes that's actually taken place in the last couple of years is policy on nuclear, and sentiment on nuclear as well. But I recall, watching this movie Anthropocene. It's this Ed Bertinsky film where one of the segments he shows what's going on in Germany, where they have these machines the size of buildings carving up the countryside in Germany for coal, because they mothballed half of their nuclear reactors post Fukushima and post Chernobyl. But now that they have this situation where their dependence on coal is causing much greater emissions than they did in the past, it's kind of nullified the whole point of under the aegis of climate change. You look at the destruction that's taking place in Germany by these coal miners, trying to extract lignite from these terraform mines. It's incredible. Now you compound that with the supply shocks, and then the war in Ukraine, and now the Nord Stream pipeline sabotage. Germany's in dire straits. So is Europe. Europe is threatened. It has highlighted how important infrastructure investments are.
Absolutely.
And it has also changed the shape of policy. So now Germany has decided to tilt towards being more pro-nuclear again. And seeing as they were buying electricity from the French nuclear utility, to make up for the shortfall in their own production.
Doesn't make sense, does it?
So many interesting things happening. I mean, we're not experiencing the same problem, but when you contemplate, the challenges of infrastructure and the value of infrastructure now that these shortages have been highlighted, certainly a different outlook for those than for traditional stocks.
Yeah, and I think one of on Germany, it's interesting because they may not be in quite as bad a state as people think they are. The gas reserves are actually fairly good at this point. Much better than people thought they would. So they have a shot at getting through this winter. I think if people could turn the temperatures down in their house 3 degrees, it would actually solve the problem entirely. Whether they do is a different story. But there's options that potentially don't make it completely catastrophic. It's next year. Next winter is the bigger concern. But the other thing that's happened with the speed of the renewables build out. There's so much focus on these intermittent wind and solar farms. People kind of forgot about how the overall power grid has to function. You need that reliable base load,
exactly.
whether traditionally coal or nuclear or something like that, or increasingly it can be the natural gas plants that can still provide that. But that's until we have all these other components of the battery storage or long-term techniques, it's going to be challenging to fully build out the renewables. And then it also comes down to if you do build this out, you have to transmit that electricity, and the U.S. is kind of interesting that way, that the bulk of renewables gets generated right in the middle of the United States, and yet the bulk of the people that consume the electricity are on the coasts, and so you need an enormous amount of transmission investment to kind of move that power from the center to the outside. And I think what we're finding is a lot of these transmission grids are incredibly old. It's 30, 40, 50-year assets that need to be significantly upgraded and enhanced over time. So the interesting thing about what's going on is that there's an enormous amount of investment opportunity, and that really hadn't been the case for 20 years. Utilities had kind of gotten boring. Nobody was building new electrical power plants. Power consumption per capita had basically flatlined or was even going down because of efficiency gains. And now suddenly we have this path for the next 20 or 30 years of very certain regulated growth as we deploy some of these solutions. But it absolutely underscores the importance of nuclear and some sort of baseload capacity until we can solve some of those challenges of intermittent production. The unfortunate thing is there's one company in the United States, a fairly large utility, that's going through the process of building nuclear, and unfortunately it has been one that has been plagued with cost overruns and significant delays. It was supposed to go online, I think, in 2020 or 2021. They're now looking at probably 23 and 24 as the more realistic timelines, and so you still have a lot of those logistical issues. We need to find ways of building smaller nuclear plants and build them faster. The really large scale plants continue to struggle.
Yeah, there's been certainly a lot of talk about the SMRs, small modular reactors, as an alternative to building full-sized reactors. The turnaround time on these projects is far longer than people realize. And again, these are massive, state-sponsored projects. In your portfolios, in these strategies, to what extent are you looking downstream?
Well, I would say on the real estate side, I mean, the policy framework, needs to be supportive for sure. We've seen over the last 5 years, the length just to get approvals on construction timelines have just blown out. Projects that did, used to be able to start in 18 months are now taking 3 to 5 years just to get policy approvals. So, that's really lengthened the cycle of construction times. Combat that with, or on top of that, you've seen construction costs continue to increase. So some of the projects, continuing to need higher rents in order to justify the IRRs. That all plays a major part in the ongoing development. But the advantage, I guess, of some of that is there's been a lack of supply that's really been brought to the market,
Right.
and that's really evident in the industrial segment. We've seen it quite dramatically, and that's a global issue. As well as in multi-res. Just one example, going back to Germany for a second. One of the companies, a multi-res company in Germany, they actually, every time they have a vacant apartment, they have about 200 applicants for that one single apartment. So it's just a huge, significant demand, right? And
Right.
very, very little supply. And the Mietspiegel, the government regulation that's in play in order to restrict rental growth, has really slowed down, that overall supply of new products. So, there needs to be a bit of a policy action too in order to help support balance in some of these markets.
The shortage of new infrastructure and the value of pre-existing infrastructure is sort of the sweet spot here, right? Because the existing infrastructure, the value of the pre-existing infrastructure has gone up because of the shortage, and the shortage is driving opportunities in future construction of new real estate and new infrastructure. So you have the opportunity in what's new and what's coming in the pipeline, which could take years and years. But there are obviously companies at the front line that are benefiting from the drive to build new infrastructure or to replace old infrastructure. But then there's also the infrastructure itself that exists that, because of the shortages, the valuations go up. So you have that double win, and sort of implicit in that is the fact that it's inflationary. So by owning these inflationary assets, you're hedging against inflation.
Yeah, and I think one interesting, or even two interesting examples on the infrastructure side, if you look at things like railways and rail tracks, the supply of rail tracks has actually been shrinking over time, just because of the logistical challenges of building it, and a lot of tracks being decommissioned. So for those who own railway tracks, it's incredibly lucrative, and there's many attributes of railways that make them much more attractive. If you're trying to move goods by airplane or by truck, it's far more higher emission than if you just put it on a train. It's actually very low emissions to move goods by train. So it has a lot of benefits if companies can transition. Everybody's focused on ESG and reducing their carbon emissions. The railways are seeing some demand just on that side. But as well, just the lack of new rail track itself creates a very strong pricing environment for these companies. And they're not regulated. That's one of the few industries where it really is competitive in terms of being able to charge a price to a client, unlike a highway or an airport where it's a much more regulated toll. But the other one that's interesting is the energy pipelines, where actually the valuations have gone in reverse. They're actually quite cheap because of the ESG concerns and the long-term value of the assets. And it, at one point it created a lot of questions as to whether there was terminal value in these assets or not. The challenge, of course, there is moving oil and gas across the U.S. and Canadian border has been fraught with a lot of political risk. It's been very, very difficult to get anything approved. And even when it is approved, sometimes it's unapproved. So there's a lot of challenges there. But even within Canada, we've seen an enormously long regulatory cycle to try to get assets built to move oil and gas from Alberta to the BC coast, for example. So it really does raise the value of all those existing assets. The good news is we are seeing new projects come in. So there is new supply coming, but it's nowhere near enough. If we'd had more pipelines, we could be moving far more crude and gas than we have. But it's the interesting part of the gas pipelines. There's been a number of studies of the U.S. electric grid and how it will evolve as it decarbonizes over time. And there's basically no scenario where you can get rid of gas. You need some degree of natural gas peaking plants. You need some degree of natural gas to heat houses. You think about the center of Canada and Saskatchewan, Manitoba. It's pretty hard to heat with electricity alone during the winter. Gas is going to be playing a role there for a very long time. I think what people have realized is that these are extremely important assets, and even more so now with the need to export gas to Europe. A lot of the companies that we own are very actively involved in liquefied natural gas and transmitting to the global markets, and that's just going to become a bigger and bigger area over the next 10 to 20 years.
Interesting. I recall a quote. I'm quoting David Einhorn from Greenlight Capital, but he said last year in a letter that the world is decarbonizing demand faster than decarbonizing supply. It's going to be a lot longer than people realize before we can actually abandon fossil fuels, and there's a lot to be said for basic uses. You both clearly do a great deal of fundamental analysis in your work, and that's evident in what we've been talking about up till now. How do you manage these unique strategies?
We basically utilized the same process. Our background obviously is coming over from Greystone with TD buying us, but we've copied or are using that same philosophy. It's a 3-step process, and really, the main differentiators, I guess, of our ETF overall, it is actively managed. Both products are actively managed. We hold concentrated portfolios, and that gives us the capability of getting attractive exposure to growing themes that we see going on in the marketplace, whether it's in a sub-industry or even regional basis. That global focus that we have continues to provide for diversification within the portfolio itself. And really achieving diversification outside of just one market. The portfolio has exposure to multiple regions. We'd going back to the process itself. So it's a 3-step process. The first step within that process is the quantitative engine, the quantitative tool that we use. We screen the universe, looking for growth characteristics that we find attractive, as well as valuation and quality, stability are all variables that we go into the model itself. From there, we'd provide short list of attractive opportunities, and the fundamental analysts on each team would dig into those higher quality or higher ranking stocks. When you find interesting ideas, you bring it forward to the team, and you have a team discussion, fully vetting the idea itself and the analysis. So, and then the portfolio discussion happens where we see how it fits into the portfolio and see how it impacts portfolio characteristics.
The one thing I would note that differentiates our products, a lot of the ETFs that have been launched over the last couple of years, are either generally passive and just tracking an index, or for the active funds, it tends to be much more quantitatively driven. So you'd have a quant model up front that just is effectively replicating what the model is doing and tracking it over time. So you tend to have a lot of upfront work developing the model. But the challenge with that approach is that markets change and markets evolve over time, and you have to be very careful to make sure that managers, if it's a pure quantitative strategy, have the flexibility to adapt, and most of them don't. One of the benefits of having a quant and fundamental strategy combined, we have the discipline of a quantitative screen up front. There's over 600 companies globally for real estate that we could invest in, about the same for infrastructure. You need a quant model to be able to process all of that information and distill it down into a manageable subset. But there's things the quant model can't pick up, and particularly for our style of investing, which is tilted more towards growth opportunities, it's very hard for a computer to try to figure out the quality of those growth opportunities and the diversity of those growth opportunities over time. That's something where a human analyst can go in and really get a much better sense of if a company has a large land bank, if it's all on one side of the country, they're very locked into the dynamics and population on that side. We want to see what the flexibility embedded in those growth pipelines, and then how effective management teams are at actually executing that over time as well. Very hard for a computer to get a sense. You can try to tease some of that out through historical data, but there's each discipline is good in its own different aspects, and we think being able to bring them together gives us a pretty unique solution. You don't really see a lot of that still in the marketplace today, and certainly one that's supported by a large institutional investment team that we are, and the ETFs have the ability to benefit from the knowledge of our fundamental analysts that are working on much larger institutional scale portfolios.
How do these liquid alternatives, infrastructure and real estate, how do they fit into existing model portfolios or into existing portfolios?
So I think for a lot of investors that are probably starting from something similar to a 60-40 equity bond split, the question is, I guess, sort of how do you start integrating real assets,
Right.
and what level do you start putting them into? I guess it's important to note that there already is some exposure if you have a broad-based equity a position, if that's kind of the starting point. Real estate's about 2% of the global benchmark, utilities around 3%. So you'd probably have call it 5% exposure already, and then times 60. So there's going to be some marginal exposure. But when you contrast that to what the private pension funds have been doing, it's much more common these days to see allocations of 20 to 30% into some of these real asset positions. And that's obviously into hedge funds, private equity as well, but a fairly significant gap between the two. So I think the one thing investors need to think about is how, and I guess one of the other defining attributes of real assets is that they tend to be more income oriented. That's going to be more appropriate for some investors than others. So figuring out what the level of income needs are in the portfolio is a key part of that decision as well. But what we've tended to see, over time, is that a lot of these more defensive assets have actually quite often outperformed the more speculative investments over the longer term, and particularly in some of our strategies where we're emphasizing quality. There'll be periods of time where the lower quality companies win out. Over the long term, if you can buy the high quality real estate, high quality infrastructure, it tends to compound over the longer term. So that it really depends on an individual's risk tolerances, but I think that's sort of use the pension plans as a reference point. They've done a lot of legwork on this over time. And then the question is kind of where do you potentially pull that from? You've got the equity or the bond side of the portfolio. And I'm not sure it necessarily has to be an either or. It's probably a little bit of both. The challenge with equity markets, we've seen a lot of valuation compression this year. Multiples are trading at effectively the long-term average today, give or take. But if you look at equities relative to bonds, the equity risk premium is actually still extremely low relative to history. So you're not really getting the multiples better, but relative to interest rates, that relative equity bond return, it's still pretty tight. On the bond side, you still have a lot of potential risk factors. Oil, we saw the 2 million cut from OPEC today.
Yeah.
The EU is going to start sanctioning later this year. There's upside risk on oil that could still keep inflation embedded for longer and interest rates higher. The Bank of Japan hasn't moved. They've stayed quite stuck at 0% yields. But if that changes and their governor potentially changes early next year, you could have a rethink of policy. That could be another wave up in interest rates. And then you still just have an enormous amount of government debt sitting on central bank balance sheets, which is depressing term premiums. The New York Fed, I just had a look this morning at the term premium on a 10-year bond is minus 75 basis points. It's normally plus 100 to 200. So if that starts to shift at some point, that's the other thing that could drive yields up. And that's the unfortunate challenge with bonds. The valuation of bonds, the term premium isn't attractive either at this point in time. So in terms of how you start integrating some of these real assets, it's probably not do you take from equities or bonds. It's probably just dialing down both and dialing up real assets in place.
What are some of the pros and cons of real estate and infrastructure as diversifiers that you've seen historically?
I would say that in certain periods, if we go back and we look at the GFC, for example, in 2008, real estate, publicly traded real estate, had a lot more leverage than was safe, and with the crisis that pursued, that cause a significant risk during the market. I think they've learned their lessons from there. We've seen balance sheets and their overall leverage get cleaned up quite dramatically, much lower leverage in today's market, much higher quality asset base. So, during certain periods, there are always, I think, macro factors that influence some of these assets. For example, as going back to our policy discussion, that's having an impact on that supply and demand imbalance. But that could reverse at some point. Doesn't look likely in the near term, but it's something that we continue to monitor.
One of the things that I'd emphasize as well is just that, it comes back to the cash flows, the certainty of the cash flows, and whether it's, the contractual nature that effectively guarantees them over long periods of time, or the regulatory structure. And these are core assets that are absolutely required by the economy. That allows you to get, at least a reasonable sense of what a floor valuation should be, unless you have a complete occupancy loss, or a significant shutdown in an electric grid, some sort of extreme scenarios. You can model that out and get a pretty good sense of what these companies should be worth at a minimum. It's much harder to do that. At the end of the day, what's the right value on a large cap tech stock or a software company, where you just don't know what the long term outcome is going to be. It's just a little bit harder to value the intangible firms and those longer term growth opportunities. So I think that's something that makes these much more important diversifiers, is just the predictability and the fact that it's backed by contracts. The other thing I'd point out is it's always nice to contrast this with the other diversifier, which people like to talk about, which is gold. And that's something that historically has had a very low correlation to equity markets. And so from a correlation perspective, it's a great diversifier. But at the end of the day, it's a commodity, and it tends to be a very volatile one. And then, of course, the gold producers, the companies, are even more leveraged to that gold price. So what you have in real estate and infrastructure are good diversifiers, maybe not as low correlation as gold, but much lower volatility, much more stable. So when you kind of combine those two into a portfolio, it's a more reliable source of diversification over time. And people like to talk about gold as an inflation hedge as well, and it is. Over the longer term, gold has outperformed the US CPI by about 5 times, but it's happened in 2 discrete bursts. It happened in the 1970s, and then the early 2000s, and then you had periods from the 1990s, 1980s and 1990s, where gold actually underperformed inflation substantially. When you look at real estate and you look at infrastructure, it's an annual adjustment to your electric bill. It's an annual step up in your rental contract. It's very closely linked. So each individual time period is going to see that sort of link to inflation. So it's a more reliable inflation hedge in our view.
To your point, Jeff, about the pension funds really ramping up their allocation to infrastructure and real estate, that happened during a period when basically the rest of us were in love with the stock market. During a period where the S&P 500, for example, had annual returns, annualized returns of 16% over a decade, which is twice the historical norm of 8%. Effectively, these assets seemed boring compared to what was going on in the equity market, in the broader equity market. Diversification means always having to say you're sorry in the context of advisor to client, right? And what ends up happening is that they're underappreciated during periods like the last decade. And so you end up being underinvested. And now we're in a situation where we wish we had overinvested in more of these, alternative assets in real estate and infrastructure. Just to cap things off, to your point, following the lead of the pension funds, who were most likely allocating to infrastructure and real estate during a time when they started to feel very uncomfortable about equity valuations and looking back at fundamentally valued assets. Any closing thoughts?
I guess one thing that I'd say is it's easy to get caught up in what's happening today. We have a very embedded high inflation situation that people are worried about. Central banks are responding quite aggressively to it, and the concern is to zero in just on that. But we're also already starting to see some signs of weakness. We've seen a sharp pullback in the number of job openings this week in the U.S. Starting to see a lot of the leading economic indicators roll over and surprise to the downside, and a lot of the components of inflation that have been sort of driving inflation up over time, ultimately will reverse. It's sort of a matter of mechanics. At some point, used cars are going to stop going up 50% and start going down. There's actually been a lot of apartment construction in the U.S. Over the last couple of years, and at some point in time, that should start to feed into rent growth and slow things down on the multifamily side as well. So there's the inflation will start to moderate, and I think the big question is, do we go back to some of the longer term secular trends that everybody was worried about before COVID? We had an enormous amount of debt before COVID. We have far more now with governments piling on debt. And then add to that what Europe is doing and being forced to do to help with the energy situation this year. The evidence tends to be that higher debt levels reduce real GDP growth over time. So it's going to be a headwind for growth. It's going to take a long time, absent a huge inflation shock, for that to roll off. We've also continued to see an aging of the population. As the population ages, that also tends to slow down growth. And on the inflation side, retirees on a fixed income tend to not accept price increases very well. Now, maybe there's wage inflation in the working age population to offset that, but at the end of the day, you've got these big structural forces that were creating lower growth and lower inflation before the pandemic, and of course, population growth is slowing down dramatically too. The birth rates, particularly through the pandemic, are now some of the lowest that we've seen in decades, and getting much closer to sort of a peak population. That's been one of the biggest growth drivers over the last couple hundred years. If this, it certainly isn't as temporary as people thought it were going to be, but there is a possibility, if you look out 2 or 3 years, that we're back to those same discussions of structurally lower growth. And if that's the case, interest rates probably have to come down to reflect that. Maybe not as much as they were pre-COVID, but certainly lower than where they are today. And if that's the case, all of the problems that the big pension funds had of too much equity risk, you can't replace it with fixed income because the yields are low. That's what drove them into alts, and I think you're going to continue to see those trends persist for, through the next decade. The fundamentals of most developed economies haven't changed, and if anything, they've gotten worse. So it just underpins how important these assets are in portfolios and long-term strategic allocations.
Thanks, Jeff. Those are great parting thoughts. Thank you, Jeff and Travis, for your incredibly valuable time and your insight. It's been terrific to chat with you.
Thanks, Pierre.
Yeah, thank you very much.